Have you ever wondered what equity really means in finance and investing? Well, you're not alone. It's a term that gets thrown around a lot, but not everyone fully grasps what it means. In the world of finance and investing, equity is a cornerstone concept. It's like the DNA of the financial world, deeply embedded in every transaction, every decision, every strategy. Think of equity as a slice of the financial pie. It represents ownership, a stake in an asset or a company. It's the value that would be returned to a company's shareholders if all of the assets were liquidated and all the debts paid off. Understanding equity is not just about knowing a definition. It's about comprehending the role it plays in the financial ecosystem, how it impacts financial decisions, and the opportunities it presents. By the end of this video, you will have a solid understanding of what equity is and why it's so important. So, what exactly is equity? Let's break it down to its most basic definition. At its core, equity represents ownership. Think about it this way. Equity is your claim on the value of something you own after all the debts associated with it are settled. Now, let's put it into the context of a company. Imagine a business as a giant pie. Each slice of this pie represents a share of the company. If you own a slice, or in other words, if you hold a share, you own a part of this company. This is your equity in the company. But what happens when the company has debts? Well, if a company were to liquidate all of its assets, meaning sell everything it owns, and use that money to pay off all its debts, the leftover value is the equity. So if you own a slice of this pie, you would be entitled to a portion of this leftover value. This is where the concept of shareholders' equity comes in. If you've ever looked at a company's balance sheet, you might have noticed a section called shareholders' equity. This is the value that would be returned to a company's shareholders if all of the assets were liquidated and all of the company's debt was paid off. In essence, equity is the shareholders' residual claim on the company's assets after all the debts have been paid. It's a measure of a company's net value. If the company was sold today and all its debts were paid off, whatever is left, that's the shareholders' equity. But remember, equity isn't just about numbers on a balance sheet. It's about ownership and control. When you own equity in a company, you have a say in how the company is run. You get to vote on important company decisions. In a way, you're not just an investor, you're a part owner of the company. In other words, equity is what you truly own. Did you know that there are different types of equity? Let's dive into this fascinating world where each type has its own unique character and role in finance and investing. Firstly, we have shareholder equity, also known as net assets or stockholders' equity. It's a key component of a company's balance sheet. You can calculate it by subtracting a company's total liabilities from its total assets. This gives you the net value of the company, representing what shareholders would receive if all the assets were liquidated and the debts paid off. The higher the shareholder equity, the more the company is worth. Next, we have owner's equity, sometimes referred to as business equity. This is similar to shareholder equity, but it's for businesses that are not publicly traded. It represents the owner's investment in the business minus any liabilities. For example, if you're running your own coffee shop, your owner's equity would be the value of your shop, plus any profits minus any debts. It's essentially a measure of what you own outright in your business. Finally, we have negative equity. This is a less desirable situation, where the value of an asset is less than the amount of debt owed on it. It's usually a term associated with real estate. If your home is worth less than your mortgage, you're in negative equity. It can also occur in businesses if liabilities exceed assets. Each of these types of equity plays a pivotal role in financial decision-making. Shareholder equity helps investors determine a company's net worth and financial health. Owner's equity provides business owners with a clear picture of their company's value, helping them make strategic decisions. Negative equity, on the other hand, acts as a warning sign for potential financial trouble. These different types of equity are not just financial jargon. They are practical tools that can assist you in understanding the value of your investments and businesses. By understanding these, you can make more informed decisions and navigate the world of finance and investing with greater confidence. Understanding these different types of equity can help you make more informed decisions when it comes to investing. So how does equity come into play when you're investing? Well, let's dive into that. When you invest, you're essentially buying a piece of a company. This piece is often referred to as a share or stock. Buying stocks of a company means buying equity. You become a shareholder, an owner of a portion of the company. And just like any other owner, you have a claim on part of the company's assets and earnings. How much claim you have depends on how many shares you own. If you own more shares, you own a larger part of the company. Simple, right? But here's where it gets interesting. The value of your equity, the worth of those shares you hold, can fluctuate. It can increase or decrease based on the company's performance. Think about it like this. If the company does well, if it grows and profits, the value of your equity also grows. Your shares become more valuable because the company itself is more valuable. This is how investing in equity can lead to profit. You buy shares at one price, the company does well, and then you sell those shares at a higher price. The difference is your profit. But what happens if the company doesn't do well? If the company struggles, if it doesn't grow or make a profit, the value of your equity can decrease. Your shares become less valuable because the company is less valuable. This is the risk in investing in equity. You could lose money if the company you've invested in doesn't perform well. So, investing in equity is a bit of a balancing act. It's about weighing the potential for profit against the risk of loss. It's about understanding the company you're investing in, believing in its potential for growth, and accepting the possibility of loss. Investing in equity can be a powerful way to grow your wealth, but it also comes with its own set of risks. And that's why it's important to carefully consider these factors when you're deciding where to invest. Why is understanding equity so important? This is a question that piques the interest of many, particularly those navigating the intricate world of finance and investing. Equity, in its essence, refers to ownership. It is a representation of your stake in a company or property. When we understand equity, we get a clearer picture of the value we hold in an investment. And this understanding is not just beneficial, it's crucial. Firstly, equity plays a pivotal role in an investor's decision-making process. It helps determine the worth of an investment. Picture this. You're considering buying shares in a company. You'd want to know your potential equity in the company, wouldn't you? Knowing the company's total equity gives you a snapshot of its net value, helping you weigh the risks and rewards of your investment. Moreover, understanding equity can influence your overall investment strategy. It can guide you in diversifying your portfolio, balancing higher risk, high equity investments with those that are more stable. This strategic balance can potentially lead to more significant returns in the long run. Equity also provides a window into a company's financial health. By examining a company's equity, you can gauge its financial stability. A positive equity indicates that the company's assets outweigh its liabilities, a promising sign for potential investors. On the other hand, negative equity might raise red flags as it suggests that the company owes more than it owns. But it's not just about numbers. Equity also reflects a company's ability to generate shareholder value over time. A company with growing equity is likely reinvesting its earnings wisely, innovating, and expanding, signs of a thriving business. In conclusion, understanding equity is like having a compass in the world of investing. It points you in the right direction, helping you make informed decisions and develop effective strategies. Equity is a fundamental concept in finance and investing, and understanding it can give you a significant advantage. So, equip yourself with this knowledge and navigate your investing journey with confidence and insight. Let's quickly recap what we've learned about equity. At its core, equity represents ownership. It's the value that would be returned to a company's shareholders if all the assets were liquidated and all the company's debt was paid off. We've also delved into the various types of equity, from common and preferred equity in a company to home equity, which is the difference between a property's market value and the homeowner's mortgage balance. In the realm of investing, equity allows investors to own a portion of the company and subsequently share in the company's profits and losses. It's an opportunity for growth and wealth accumulation, but it also comes with its fair share of risk. Understanding equity, its types, and its role in investing is crucial. It helps you to make informed decisions about where and how to invest your money. Remember, understanding equity is key to making informed financial decisions. Thank you for watching, and happy investing.